Good afternoon to our friends here on the East Coast. Good morning, folks in the rest of the country. Thank you for joining our brief but hopefully informative webinar on the true cost of life insurance. This is a fun topic for me. The study and the software build actually put me over the edge to purchase a policy, particularly in the times that we're in, where I feel I can dollar cost average some undervalued sub-accounts. Also on the line, I have my partner, Adam DeMarco, who's making his first cameo in our Friday Life Share webinars, and he's broadcasting in the comforts of his home with his dog Carl and his daughter Audrey, likely in his plaid pajamas. So we'll have a little bit of fun. This is going to be really fast. Within an hour or two of the close of this session, we will distribute a recording of the call along with any handouts. So we should have some time for questions at the end. So please type your questions in the chat box under questions in your control panel. So we're going to dive right in. So very quickly, we're gonna cover: are we funding a lifestyle in retirement, or are we building a balance sheet? That seems to be the misconception with retirement plans, right? Looking cool on paper is one thing, but being able to provide an income stream to support a retirement lifestyle is another. We're gonna cover life insurance is expensive objection. This is gonna be an eye opener for you. I know it was for me, to just compare the costs associated with policy fees versus investment management fees and taxes, and that's really the trade. We'll touch on what this stimulus package has done to the national debt, where we see tax brackets going. Share with you the software tool that we think you can use with your clients. We can build this software out in your colors and your logo. It is an amazing tool to add to your arsenal of client material. Adam, we're going to bring Adam in. He's the guru, product favorites and deals to be made. So, products and features are one thing, but, can you actually get a deal done in underwriting and without exams and expeditious APS? So Adam will spend a couple minutes there, and then we'll show you how to get this program started and utilizing the CARES Act to potentially fund the first year's premium, which is a really interesting strategy, and I'm actually doing this for myself. So just very quickly, are you funding a retirement lifestyle, or are you funding a balance sheet? And I've covered this before. Those of you who have sit on this on our life shares before this is not meant to be repetitive. But what I will tell you is that this is a huge, huge, huge deal, right? If you have life insurance and you have a volatility buffer, you need significantly less assets to be able to afford to retire. So, I want to reiterate that at $1.4 million, $1.6 million, generating the same 100,000 of income using actuarial science products versus having to accumulate 3.9 million in an investment portfolio. So just a quick refresher there. I'm going to dive into the presentation right now, but I always like to start with the assets needed chart, and this is a fantastic tool. So moving on. So life insurance is expensive. So what does that mean? We hear this all the time. Oh, whole life is expensive. Index UL is expensive. Variable life is expensive. But what does that mean? So expensive, the definition of expensive is that it costs a lot of money. Well, okay. Your cars cost a lot of money. Your home costs a lot of money. You're not buying the cheapest home on the block. You're not buying the cheapest car on the lot. You're looking for value. You're looking to create an asset. And when you really look and compare what you're getting in terms of buying a more efficient vehicle, you're in hopes of getting better gas mileage or luxury amenities or the less frequency of repairs. So in the long run, expensive doesn't always mean the most efficient. And I would pose the question, or I would pose the subject, there are two trades that I'm willing to make every day. Trade number one is I'll trade policy charges for tax efficiency every day of the week when it comes to funding lifestyle. not for building a balance sheet, but funding lifestyle. I will trade policy charges for tax efficiency any day of the week. And the second one, and what we're going to quantify here, the numbers are quite staggering. I'll trade investment fees and taxes for tax efficiency, right? My investment asset, paying investment fees, and I'm paying taxes upon sale, liquidation versus tax efficiency in a policy. We're gonna literally dive right in. So this is me, right? Male 44, preferred, 10 pay, $4,000 a month. So I'm going to put $480,000 in over 10 years. If I deployed this into an investment, you pick it, stocks, bonds, mutual funds, and I assume a 1% management fee. Yes, insurance is expensive because on a $48,000 premium, I get $8,200 going to policy charges in year one. Conversely, with 7% growth, my $48,000 grows to $51,000, and a 1% fee, I'm paying $514 in a management fee. So yeah, if you're looking at year 1, year 2, year 10, year 20, insurance is expensive. There's a $139,000 differential, and don't let this confuse you. I'm going to get into the model very quickly. You're going to see that insurance is expensive, but what we're not taking into consideration is the trade. What am I getting back in the trade? And I'm getting back tax efficiency and non-taxable distributions, where the investment side of this analysis creates taxable distributions. So this is key point number one. We're gonna dive in here. So let me erase this. I'm gonna move on to the next slide, and we're gonna keep chugging along. Now, we looked at the fees. Let's look at the taxes. Okay, so now I've accumulated significant amount of money in the left side of my investment and the right side of my insurance policy. And 21 years down the road, I'm 65 years old, and I start taking distributions. Cumulatively, from age 65 to 85, the investment is going to generate $263,000 of taxes. Okay, so here's trade number one. And I'm going to quantify this again with exclusion ratios. This is a real kick-ass spreadsheet that we put together, again, that we can customize in your colors and your logo. Let's talk about policy fees very quickly. This is a max funded policy. I pulled this out of the ledger. Male 44, preferred is on the left, and table D is on the right. Now, 44-year-old, low charges, right? Over 10 years, I have 8,200 of COIs, I have 49,000 of admin costs, 28,000 of percentage of premium charge. They're my charges. They're somewhat reasonable. In comparison to table D, doesn't really make much of a difference if I'm max funding, but you do see that the COIs go from 8,200 to 20,000, right? So remember, when we're considering doing this, we're trading policy charges for tax efficiency. If the policy charges are too high to yield the benefit of tax efficiency, we simply don't do it, right? We look more towards the investment side of the equation. And that's, again, what this software, where I'm leading you. Here's a 74-year-old, and this drives home my point. So now we're talking about 40,000 of COIs because it's 30 years from now, and I'm 74, right? I don't think I'm going to buy an accumulation product at age 74, but, you know, who knows? We don't know what tax rates are going to look like, but the analysis, again, will take you through policy charges versus tax efficiency. Pretty simple. So these are basics. They're just the very basics on policy charges. And every illustration would actually offer this report to you. The second trade is investment fees for policy charges. So when you step back and you really think about this, and I'm happy to provide these third-party materials and links to these articles that I used. I grabbed from Schwab, I grabbed from Forbes, I'm grabbing from pretty good third-party resources. So how much to invest? What is the true cost of investing, right? You have your disclosed costs, which your expense ratios, and everybody goes to Morningstar. Oh, what's it cost? Oh, they're only 50 bips. Okay, that's great. But then what are the hidden costs, right? What are what are the brokerage commissions? What's the difference between the bid and ask price? When you make large trades, you typically move the price, right? When Warren Buffett sells his airline stocks, he's moving the price of the airline stock down. So, they're the hidden costs. You have costs due to tax inefficiency, right? You got some dogs in there and you want to sell them, and maybe you have some gains, maybe you have some losses, but there's some taxes incurred on the trade. And then the fourth cost is the sneaky cost. It's the window dressing for the quarterly calls. When Fidelity wants their shareholders or their investors to see really good quarterly results, they may shed some of the losses prior to those calls. So these are things that the average investor doesn't really look at. But let's just give the fund and the ETF companies the benefit of the doubt, and move on to the next subject matter, which are warning signs. We're seeing some big warning signs. So we're considering fees, remember, and then we're considering taxes. And they're the two buzzwords for looking at this particular analysis and pushing the consumer a little bit further towards the life insurance side of the strategy. So the $3.5 million stimulus that we just passed took us over the top, well over the $25 trillion number. And as a percentage of GDP, we actually surpassed the World War II era. And again, this is from the USA Today. All these third-party references are available to you. I'm happy to share links. This is a warning sign of where taxes are about to go. This is when you're managing income streams in retirement, right? The difference between 163,000, once you get over 163,000 of taxable income, you're moving into the next bracket, which is a pretty significant difference of 8 points. And what's even more concerning is that, let's assume you're married and one of the partners pass. The spread and the difference between tax brackets of single payers versus married filing jointly are the widest we've seen in a long time. So, the married folk that are at 208,000, right, let's say paying 24%, and we kill one of them off, right? Now you're pushed automatically without doing a single thing into the 35% bracket. So tax efficiency for fees and policy charges. I'm going to keep going, and we're going to get to the punchline here very shortly with the software analysis. But again, this is what my friend Adam calls the setup. So we built a model. There are so many good tools out there between InsMark and eMoney and Money Guide Pro, and the insurance carriers do a great job with it as well. But I've yet to quantify, what does it mean? What does it mean to invest long-term by way of fees and taxes? What am I giving up as a percentage of the asset, and how does the insurance compare? And that's exactly what we wanted to bring to the market, particularly in today's world where consumers are looking at where to put their money. Is there a safe place? Is there an ideal spot? Can you create leverage? And can you create wealth in an environment like today? So what's interesting here, and it's important, and I don't want to bore you, but I think it's important that you see, we're able to decide whether we want to create the analysis of insurance policy against an ordinary or an equity asset. And the big difference is, if you're comparing an ordinary asset, let's say you're a believer in whole life. Well, you want to compare asset class to asset class. So you want to compare the whole life to an ordinary asset like a bond fund, right? And there's different taxation involved with ordinary assets. So it's ordinary income tax bracket. So you want to create a fair comparison. Conversely, if you're buying VUL at the far other end of the spectrum, you want to compare that against an equity portfolio because it's the same asset class. So I'll just change the drop down from ordinary to equity, and the equity asset tax bracket would change from 40 to 30. So the software is very intuitive. And we're also taking into consideration withdrawal rates from the policy and reverse engineering using the cost basis and exclusion ratio on what the pre-tax amount would need to be in the investment asset to match the same net distribution rate in the withdrawal amount from the policy. And then we take into account the management fee, which is a very fair, right? We talked about 4 costs of investing. I'm only taking into consideration the disclosed costs. So if you want to really get analytical and you want to throw in potential hidden costs and sneaky costs and bid-ask price issues and turnover rates, we can do that, and you can juice this management fee to whatever number you want it to be, and it'll make for a hell of a presentation. So I'm gonna keep going and start digging into the solution. So very basic. This is what the insurance ledger looks like. Simple. Okay. There's whole life on the left. There's variable life on the right. If I had enough room, IUL would be in the middle. And we're very simply comparing 10 years in of deposits, 20 years out of income, your account value, your cumulative value that you've received from the transaction, and your death benefit, right? Simple. And when you put this in front of a client, how many times do you say, ooh, 29,000 in year 1. Well, I gave you 48. Insurance is expensive. Okay? Fair. It's fair. If you're looking at this as a balance sheet item during the first 15 years. Fair. Very fair. Now, if you get up beyond that and you can start seeing beyond the distribution phase, you're going to see that the insurance is a hell of a lot more efficient than the investment. Now, what you're seeing here, I'll start to pull this apart. This is the investment only, and I'll share this with you. Just very quickly, in column 1 and 2, these are the pre-tax amounts needed to net the same withdrawal rate the insurance policy was providing. And for the first time in, I think, like forever, I finally have a clear depiction on how that is broken out. In order to net 92,000 withdrawal, like I'm doing on the insurance side, which I'll get to in the next page, I need to gross up using a 40% basis to exclusion ratio. I need to gross up distribute 112 from the investment. I break out for you tax-free portion in column 3, taxable portion in column 4, and here's how we get to your net. That's a pretty cool exercise and one of the main features of the software right out of the chute. Now, what's even more interesting, and this is where, we don't want to offend anyone, but we're going to talk about the annual loss of value to fees in column 12. So, yep, it's only a $514 management fee in year 1 because it's 1% of 51,000. But let's talk about age 60 and 61 and 62, and I'm paying 10 and 12 grand a year for management fees, which cumulatively reaches over 202,000 that we're paying to the wealth manager over the life expectancy of the policy. So again, we're not picking on wealth managers here, but we're talking about expensive, the term expensive and inexpensive. And if you're looking at this long term, again, building a lifestyle, not building a balance sheet, you're losing $200K just in management fees. So that itty bitty 1% in year 1 grows to be something very meaningful later on. And then you bring Uncle Sam into the equation in column 14. And the spread between the gross up in column 1 versus the net in column 5 is what we get here in column 14 and what we're giving up in taxes. So taxes cumulatively at $263,000, management fees at $202,000. Well, hell, $466,000 lost to fees and taxes. So now what are we starting to, where does the conversation go from expensive to inexpensive, right? And what is the value that we get? So I'm going to keep going because I know this is hard to see. And again, I didn't have a lot of room. So I tried to blow up certain sections of this presentation. And here you can see a little bit closer the annual loss of value due to fees, and cumulatively 202,000 before the account completely runs out of money, which I'll get into in a moment, because the insurance is just more sustainable through the use of withdrawal basis and policy loans thereafter. So there's your 202,000 to the wealth manager. There's your 263,000 to Uncle Sam, assuming tax brackets stay the same, which we've been given warning signs that they likely will not, and assuming your spouse lives forever and you're still in the same filing jointly status, $263,000 to Uncle Sam. So you want to talk about expensive? $466,000 over my life expectancy on $480,000 investment is pretty expensive. So it's all relative, right? And this is not a knock against wealth managers, because if you've heard my presentations before, you know that we need banks and wirehouses to generate yield. We need the 15s and the 18% types of return, but we still have to pay fees and taxes. So most consumers are 100% investments and 0% insurance. I think what this spreadsheet will start to suggest is that you start coming to terms with reallocating some of your assets, like I quite frankly have, and I put it into the seminar invite. I believe that my taxable assets are going to be less valuable in the future because of A, where tax rates are headed, and B, the fees that I'm paying on them. So I'll show you a little strategy that I used at the close of this presentation that could be the launching pad for your year one premium. And here we are. Now we're getting to the fun part. We talk about building a lifestyle. Well, life insurance distributes really well. And on this is a VUL at 7% nationwide. Very, very favorable policy charges, because remember, we're analyzing policy charges versus tax efficiency. Very good policy fees. I am bullish right now. I feel like if I was to average on the way down in this market, a decade from now we'll be sitting pretty. But don't let the product choice cloud how you view this presentation, because remember, if you're a whole lifer, then you compare it against an ordinary asset. If you're an IUL believer, then you compare it against a blended portfolio of stocks and bonds, and you slow it down a little bit. If you're aggressive and like me, then you compare it against an equity and you throw in the VUL. But at 7% using fixed loans, I showed an income stream of $92,688 from years 21 to 40. And now I give that information to this software, and it starts to compute for me where I showed you early on, what's the pre-tax amount I need to draw down in order to utilize the exclusion ratio of tax-free portion and taxable portion to net the same $92,000. And lo and behold, I run out of money at age 77. Okay, which is about 9 years before the insurance stops taking distributions unintentionally. And the insurance will actually run for a lifetime, but I stopped. In this instance, I took max withdrawals, loans to basis, withdrawal to basis loans thereafter from years 21 to 40. So what you're seeing here is the sustainability with fees and taxes taking into account, which clearly depicts the long-term bucket. If this is a long-term bucket or a long-term asset, the insurance asset to asset class is a better economic vehicle. Now I'm going to turn this over to Adam DeMarco for a moment, just to cover Adam. If you haven't met him or interacted with Adam, he is the best product and technical guy that I've ever worked with. I'm proud to call him my partner. He's going to dig in just for a couple minutes, and we're going to bring it to a close. How to get deals done, right? Depending on what product flavor you like, why he makes certain recommendations, what carriers he's seeing doing a good job with policy fees and features, and I'll give him the floor for a couple minutes here. Adam?
Thanks, Anthony. And the pajamas are blue, not plaid, by the way, that you mentioned earlier. The first thing that we're doing is, I mean, there's kind of like this underwriting stimulus out there. I mean, it's so much going on if they open the doors, because the insurance companies are in the same spot that we are, where they need to get business in the door. So accelerated underwriting programs, we got a ton of different options out there. But one of the things that I want to take away with, it's not just for the $1 million term policy for $50 a month. You could get $3 million of IUL with a variety of carriers or stack them together. You're talking about $50,000, $100,000 you could put away into something like that. We had a young entertainer with no exam where we were able to get an offer for up to $40 million because of what was in the file. So when you look at what's available today because of the circumstances, there's some bad, but there's also some open season to really conduct business in a way that is minimally invasive for clients and to get high-end deals done with with an email basically and a couple of inputs into a computer screen. So depends on the product that you're funding. We're product agnostic here. There's no one carrier or product that's the solution for everybody. And Anthony talked about how this analysis that he's doing is going to compare against multiple product lines. When you look at IUL, what I'm looking for is low cost, because costs are stickier than performance. And we could stabilize the income, like Anthony said, where he said that we're building a lifestyle, building a retirement plan, not a balance sheet here. There's riders out there that can really stabilize that, the guarantee income riders, and there's also indexes and specialty accounts that are in some of the products, and we have even some proprietary access to some products that are really well hedged that can smooth out returns and just make a really sustainable transaction to be able to distribute the money that you build out and distribute it on a tax-free basis. On the whole life side, there's just kind of two different streets we could go down. We could look towards early liquidity. So there's some high cash value products that are out there, or we could look at whole life plans that are built for distribution on the back end. And when we were looking at some of the very aggressive designs that existed a number of years ago in the index space, particularly with participating loans before there was rules against what you could show, whole life wasn't playing in that space. But as the market came down, as the regulations came down to allow for more realistic projections out of an IUL and some safeguards in the illustration system, whole life looks great on a distribution basis. And when you're looking at companies that have non-participating dividends, non-direct recognition dividends on participating whole life contracts, you could get a lot of money out of them, and interest rates are low and dividends are staying high with a lot of companies. And, New York Life and Mass Mutual's in that space. On the direct recognition carriers, we have Penn Mutual's got great distribution on a fixed basis, and they also have really great accumulation story with their term blending and PUA riders. So it's just a matter of what's important to you. Are you looking for guarantees in the contract? So then you could remove the carrier and you can't tell them apart. They all look the same. Are you looking for high-end projections? And that's if you want the money early, do you want the money as a retirement income, or are you trying to build up paid-up additions, death benefit? So that's kind of the distinctions between how we're designing whole life contracts. And when you look at a lot of the short pay designs that are out there, you could do 5, 10, 12, 15, 20 pays. You could do long-term care riders. So the whole life space is getting a little more dynamic and has a little bit more to it than what we've looked at in the past, or the traditional thinking the whole life is you pay it to 100 or you pay it to 121 and it's inflexible. That's not the case anymore because of how the industry and how these products have innovated in that space. And then finally, VUL. So VUL, I've reviewed thousands of VUL policies, and a lot of them have not worked out. The majority of them haven't. But the key component of that is funding. It's actually not the product itself. It's not the riskiness of the product. It's the aggressiveness of the design. If you show anything that has to work out by getting 30 years of 12%, it's not going to work out, or it's going to work out very infrequently. If you fund that VUL, like an IUL, in today's VUL space with the consumer safeguards that are in that, there's even income riders in the VUL space, there's guarantees in the VUL space, and there's some really low-cost designs, low-cost products from a fund standpoint and also from an insurance cost and expense standpoint. I mean, if you overfund that, there's something to that, and we could help you, steer you in the direction of the variety of different options that exist in that space, whether it's, looking for investment options, or you're looking for low-cost options, or you're looking for, some of the riders and guarantees. That's a vast space that we could get you guys familiar with. And, I'll just leave you with this. It's, if you were to be in these funds, and there's nothing wrong with being in investment funds, like Anthony said, it's a strategy for some or all of your money. And traditionally people do that. The funds that exist in these VULs are the same funds that your money manager is going to be putting in. And there's even some more dynamic investment options in there, some actively managed funds that, clients of a certain size investment wouldn't even have access to. But when you look at the Lincolns and Nationwides of the world with their investment strategy desk that can help you pick the investment allocations, there's some management of investments that are really interesting, and you're not really trading off much as far as the investment potential, and you're not trading off much and by way of fees, because you're just buying the same things you would have bought outside of the BUL. So then it's just about controlling the cost of the BUL itself and the insurance costs, and we're going to do that through the funding. So it's exciting what exists in that BUL space today, Anthony.
Thank you, Adam. And a lot of these VULs, one of the questions I see in Q is linear return of 7% in a VUL. I think in any product is certainly somewhat optimistic. So it's a very good question. But again, I wouldn't fixate on the product so much, because we're comparing asset classes. And what Adam may have alluded to is that some of the VULs, two in particular, actually have index sub-accounts. So if it does come to distribution time and you want to slow things down a bit, and you're not interested in the big volatile swings, and you're looking to smooth out the income, there's some very competitive index sub-accounts like an IUL, exactly like an IUL within the VUL chassis. So again, it's all about what flavor you like the most, and then comparing it against a similar asset class. And we'll just kind of bring you full circle. Adam mentioned product and features is one thing, but getting deals done is another. So we're extremely equipped to get your deals done from an electronic standpoint and an underwriting standpoint. So I would encourage you to check out our website and our hot sheets. But I'll leave you with this. Me personally, and this is the header in the invitation, me personally, I think that particularly with first round of stimulus completed and likely another 2 or 3 or possibly 4 rounds, I think there's nowhere but income taxes to go but up. And after seeing the analysis of the fees associated with investing and some of the hidden and what I call sneaky or efficiency fees on top of the already disclosed fees, then I, for one, wanted to get money out of qualified assets and into non-qualified assets. And one avenue of doing this, and this is certainly not a recommendation or tax recommendation, but this is something that is being used amongst folks who have been affected by a quarantine. You are able to waive the 10% early, the IRS is waiving a 10% early distribution fee up to $100,000, and they're allowing you to spread that tax out over 3 years, or giving you the opportunity to repay your qualified plan with the early distribution by the end of that 3rd year. And some of the qualifications are extremely flexible, and being quarantined is one of those qualifications. So if you are looking for seed money to start one of these programs, and you are aligned with my belief that taxes have nowhere to go but up, and you can quantify the fees or the trading policy fees for tax efficiency, and analyzing the true cost of investing in traditional mutual funds or ETFs, I think this is a recipe for selling a bunch of accumulation policies, doing your client a service, and really putting everyone in a better position. So as we continue to try and do is add value to your practice, I hope today's webinar was informative. We've gone a little bit over the 30 minutes allotted. I appreciate your attendance. Again, within 1 hour, you'll get a copy of the handouts and the recording. And if anyone would like to speak to us offline, we'd be glad to take up the conversation. So thank you again. Have a wonderful weekend. Stay safe and stay healthy.